Hey everyone, welcome back to Corporate Decoder. Today, Iron Dome Acquisition Corp just filed an 8K reporting on its initial public offering, and I'm seeing one really interesting detail about how they are funding things. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is primarily about the completion of their SPAC IPO and setting up their trust account, but there is a bit more to unpack about how much cash they actually have moving around. So what we have here is a document called a Form 8. Think of it as the company's way of telling the public about big, important events that happen outside of their regular financial reporting. It is like a news bulletin for investors. This particular filing is from Iron Dome Acquisition Corp, which is a special purpose acquisition company or SPAC. These companies are essentially shell companies formed to raise money through an IPO with the sole purpose of acquiring another company. The key date here is May 18, 2026. This is when the main events this report is about actually took place. The company we are looking at is Iron Dome Acquisition Corp, and you might see it referred to by its ticker symbol IDACU. This is all being filed with the US Securities and Exchange Commission, or the SEC, the government body that oversees the stock market, to make sure companies are being honest and transparent with investors. They are also checking this box to say they are an emerging growth company. This means they are a newer, smaller company that gets some relaxed reporting requirements for a period of time. It is like getting a bit of a pass while you are still growing. Now let's get into the main news contained in this filing. This section, item 8.01, is for other events, meaning things that are significant but don't fit neatly into other categories. The big news is that on May 18, 2026, Iron Dome Acquisition Corp completed its initial public offering, or IPO. They sold 15 million units for $10 each. Think of units as a package deal, often including shares and warrants, which are options to buy more shares later. On the same day, they also did a private sale of over 2.7 million warrants to a related company for $1 each. Here is where it gets interesting for a SPAC. Almost all the money raised from the IPO, plus some from that private sale, a grand total of about $150.75 million, was immediately put into a special trust account. This money is held aside for the public shareholders and the investment banks that helped with the IPO. It is basically a safety net to ensure there is money available when they eventually find a company to buy or to return to investors if they don't. The very next day, May 19th, the investment bank that managed the IPO decided to exercise something called an over-allotment option, also known as a green shoe option. This is where they agree to sell a few more shares or units if the demand is high. In this case, they bought an extra 700,000 units. And on May 20th, the money from those extra units, along with some other funds, also got added to the trust account. This pushed the total amount held in trust up to about $157.78 million. So in just a few days, they've raised a significant amount of money and put most of it into this secure trust. This is a standard move for SPACs. The money isn't freely available for the company to spend on operations until they complete a deal. This section details the different types of securities the company has issued. Here we see the description of the units. Each unit is made up of one Class A ordinary share and half of a redeemable warrant. A warrant gives you the right, but not the obligation, to buy a share at a set price. So these units are like a bundled investment. These are the common shares that come as part of those units. And this describes the warrants. For every 2 of these warrant pieces you have, you can buy one Class A ordinary share for $11.5. This exercise price is important because it sets a cap on how much profit you can make from the warrant itself. This lists the symbols used to trade these securities on the stock exchange. This is the ticker symbol for the units, which is IDACU, and these securities are traded on the Nasdaq stock market. It is a major exchange where many technology and growth companies are listed. This part of the filing points to any additional documents that are attached, like financial statements or other important exhibits. The most significant exhibit here is Exhibit 99.1, which is an audited balance sheet as of May 18, 2026. This document will show the company's assets, liabilities, and equity on that specific date, reflecting the IPO and private placement activity. And finally, we have the signature section. This is where the authorized officers of the company sign to confirm that the information in the report is accurate to the best of their knowledge. The report is dated May 22, 2026, which is a few days after the events it describes. The filing is made on behalf of Iron Dome Acquisition Corp. The signatory is Tom Y. Livni. His name is Tom Y. Livni, and his title is Chief Executive Officer. This means he is the top executive responsible for running the company. So, what does all this mean for investors? For a SPAC like Iron Dome Acquisition Corp, the IPO is just the beginning. The primary goal is to find and acquire another company. The money raised and held in the trust account is crucial for this. They have about 18 months to find a target company. If they don't, the money is typically returned to the shareholders. The IPO process itself is a way to get the capital needed for that future acquisition. The details about the units, shares, and warrants are important for understanding how the company is structured and how investors might participate in its future. The fact that a large portion of the proceeds are in a trust account shows they are following the typical SPAC model, which is designed to protect investor capital until a deal is struck. Now, looking at the broader implications, the success of a SPAC hinges entirely on the quality of the acquisition they eventually make. The IPO is less about the company's current operations, as it is a shell entity, and more about its potential to find and merge with a promising business. The key risks are always whether they can find a good target, negotiate a fair deal, and if that target company can then deliver on its promises after the merger. Looking at this filing, the immediate story is the successful fundraising and the security of those funds in the trust account, setting the stage for the company's main mission. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, give it a like and subscribe for more filings decoded. Check the description for our Discord link.